Well, thank you, and good morning, everybody. It's going to be a great privilege for me to spend the next half hour or so talking to Doug Peterson, who is the head of S&P Global, one of the most powerful institutions that in the realm of markets that I've been covering for many years now. Doug, thank you very much indeed for joining us.
Thank you, John. It's great to be here, and thank you also to the BAB for hosting this event.
The amount of interest this year in ESG is quite a step change, which in itself is impressive because the trend over the previous 5 or 6 years had similarly been remarkable growth in interest and take-up in ESG, particularly through exchange-traded funds, many of them obviously tracking indices produced by S&P. What I'm interested in is how did ESG get to this point? Like a few decades ago, it was ethical investing and it was about exclusion rather than looking for examples of good behavior. It was about largely excluding sin stocks, which plenty of people might have a perfectly good reason to do. Then it became socially responsible investing. How have we got to where to the ESG that we have today, and how has this incredibly traumatic year, do you think that's going to change ESG further?
Well, the ESG started really over 20 years ago in the Scandinavian countries when their pension funds started looking to see how they would have long-term sustainable investing through the pension funds. In addition, in Norway in particular, they had an oil economy and they were looking at how they could start thinking about an oil transition way ahead of anybody else around the rest of the globe, and looking at how to invest the oil wealth is almost like a bonanza or boom of oil wealth, and understand how they could invest that for the long run. And so in Scandinavia over 20 years ago, ESG, in particular climate, was a key factor for investing. And you can see the way it's fanned out around the rest of the globe, moving from Scandinavia into Northern Europe, from Northern Europe into Asia. There's institutional investors in Canada, Australia, in Singapore, Tokyo, that it started taking it up. And really this year in the United States is when you've started seeing it pick up a lot of speed. And it's because of the pandemic itself. It's the actions of companies who've had to think about how am I going to treat my employees, how am I going to think about my supply chain. It's also the broader racial equity themes that have popped up, that companies are much more conscious about the stakeholders around them. And this is a year where we see that ESG is become a key topic that people are talking about. But when you go back, you mentioned the benchmarking. Yeah. The Dow Jones Sustainability Index actually just had its 20th birthday. So that's been around for over 20 years. And you're also right about what were the original factors were more exclusionary. And now the ESG passive as well as active investments are built around different themes: low carbon, no carbon, ESG, impact funds, et cetera. And I think it's a place now that is going to be moving much, much faster than it was.
Now, I think that, well, let's stay on equity investing for a moment. I guess there are two concerns about the growth in ESG that I'd say that have come up. One is that the FANG stocks, as we all now call them, the really dominant internet platform companies, happen to look very good on ESG criteria. They tend to be, generally they have good governance. They are socially responsible and they don't emit a lot of carbon. That does raise the issue because the FANGs have had an extraordinary year. Is there some element of performance chasing, that people think they like the virtuousness of ESG, but in fact, it's the fact that they've been doing so well recently that gives them that sense of permission? Is this something that could endure? And I suppose the other question, which is very important, is what are the dangers? And I guess this particularly applies to a company like S&P that's providing the benchmarks, providing ratings. How do you avoid claims of greenwashing, of allowing companies the obvious favorable reputation and the access to capital that comes with a good green rating when they don't deserve it?
Well, to start off, the ESG is not really well defined, and so you obviously will see a lot of mainstream ESG indices or funds are going to have a lot of the FANG stocks in them because they pretty easily meet most of the screens. Although some of the FANG stocks do have a higher carbon output because the size of the data centers that they run, and they need to think about how they're going to decrease or come up with a way to mitigate the amount of carbon which they have from that point of view. And then because of the S and the G, they also need to look at their governance. Some of those FANG stocks have dual class stocks, which is not a great governance model, as well as in some of the cases, the S model, you need to look at their supply chains, et cetera. So I don't know how they necessarily individually are looked at on the ESG scale, but there are areas within the business model that would need to be looked at quite closely to see, do they really have high ESG scores overall? But right now, the ESG scores and ESG funds are not very well defined. You know, they range from some that have a very complex ESG factors taking place, the E, S, and G. You have funds that maybe at the other end, which are impact funds that only invest in things like sustainable, renewable energy, or only in women-owned businesses, things that are more very well-defined impact type investments. But where I see a lot of movement now is towards ways to invest that have a sustainability approach or an energy transition approach for carbon. So instead of just looking at no carbon, it's how do you look at the transition for carbon? So there's something, for instance, called clean oil. Clean oil, as opposed to, I guess you could call it dirty oil, is oil which is coming out of wells that they don't flare the gas. It's the way that it's transported is a much lower carbon output on the transportation, the way when it's refined, the way it's used, et cetera. So there's a lot of, this is a very complex field, and the standards aren't really well defined yet, which is one of the things that we're interested in being part of, to define those standards. And one other thing I'd like to mention is a little bit embedded in your question is, you know, what's driving all this? And a lot of this is being driven by asset owners, as opposed to the asset managers and the institutional investors. It's the people that are behind who actually own the assets. It's the pensioners, it's people that are the owners of the funds, it's endowments, it's pensions, it's insurance companies. And the people that have an interest in those assets are saying, well, what's going on? Where are my investments? How are they being invested? And so there's pressure coming from that side. And one of the pressures is going to be coming from the baby boomers' children. The baby boomers are starting to retire. It's probably the largest wealth transfer ever in the history of the globe. And that's not just the US, it's also Europe and Japan. And the new generations are very interested in how their funds are being invested. So there's a lot of pressure coming from that side.
Yeah, I can certainly confirm that. I sit pro bono on the investment committee of my old college's endowment, and I can assure you are exactly right that there is an awful lot of pressure coming from the younger generation, as in the students, to want to know exactly what the college is investing in. It's a plainly generational effect. How do you see? Obviously, the standards are relatively unclear. Is this an area where it behoves S&P and some of your competitors to actually come together on some standards, like for example the GIC standards for equities, come out of very much of a collaboration involving S&P, or is it better to continue to have competition for a while, risk that confusion while allowing new entrants to come in and yourselves to come in and see if you can improve your ratings, improve your data? How do you see us getting beyond the level of confusion we have at the moment?
Yeah, there's sort of three different broad groups involved in this. You have the private sector, and there's over 30 different organizations, including ourselves, that are producing some sort of data or analytics or ratings for ESG. And so that group in itself at some point will probably start seeing winners and consolidation along the way. Another set of actors are those that I'd call them the NGOs, or some of them are even governmental bodies. There's groups like SASB and the Task Force for Climate-Related Financial Disclosure, and the Carbon Development Project, CDP. et cetera. You have a lot of different organizations that are also looking at standards. And then you have the governments themselves. You have the regulators, the equivalent of the Securities and Exchange Commission. And I put the exchanges somewhere in between, because the exchanges do have listing standards, and in some ways they're not really regulators, but they have listing standards. And all of these groups are working together to see how you would develop standards. And as an example, the World Economic Forum, the IBC, the International Business Council, has worked with the 4 big accounting firms to come up with a set of standards that are actually aligned with the other ones of TCFD and GRI and SASB, et cetera. But I do think that the private sector, along with these NGOs, are going to converge on standards faster than probably what will come out of the securities regulators. The Paris Climate Accord has there's interest going on in Europe in particular now for more climate reporting, which could end up in securities regulation. But the standards, I think that we've gotten complicated. We need to start, what I'd love to see is that a group of large corporations and financial institutions take a step back and agree on a very small number of more simple disclosures that all of us will make. And as an example, in our case at S&P Global, we have published now 2 years in a row the Task Force for Climate-Related Financial Disclosure. We've done 2 reports on that. This year, not only did we report according to that framework, we've also included a carbon-adjusted EPS measure in there, which is a new metric for us. But it would be great if we could get companies. Now, the UK is going to be mandating TCFD reporting for corporations over the next few years. It's going to phase in. But beyond that, I do think it'd be great if the private sector, along with these NGOs, we would agree on a smaller number of disclosures that we could all make. If they're industry oriented, that's even better. And I do think that kind of a dialogue is going on right now, and we will see a lot more movement over the next few years. Instead of having a proliferation of standards and players, it's going to start narrowing down.
And then would you have some element of a carrot and a stick in that case, i.e. if once all the big rating agencies have agreed that we need data X, Y, and Z, you're effectively removing yourself from the ability to get a rating or to be inclusion in an index, unless you, at the very bare minimum, tell people about this.
Well, 2, and interesting on that, one would be that there are going to be, whether it's a rating agency or it's an index, you could get excluded from an index. And I'll give you a couple of the carrot sides of that. In Japan, in 2018, the GPIF worked with us to put in place some benchmarks for carbon and ESG, and one of them is the the S&P JPX index, which is a carbon-oriented index. And at the time, only about 300 companies in Japan were able to be part of that index. And now, 2 years later, it's up 58%. It's over 500 companies that are eligible because the companies actually paid attention and started making changes, so they would be eligible for that index. Another example in Europe, we, in our rating agency, we produce what we call ratings evaluations that have ESG factors. Our analysts meet with management, so they include a preparedness score as part of it. And many of those companies have now gone to their bank group and said, will you price my revolving credit based off of my ESG score? So as my ESG scores improves, I will get a lower spread on my revolving credit. And some banks have started doing that. So we're seeing not just the sticks, but also some of the carrots starting to evolve in the market as well.
I mean, in the case of revolving credit, it's both a carrot and a stick at the same time. If you start polluting more, your interest burden could go up.
Exactly.
That's a very effective mechanism. Now, could we talk more broadly now about what this implies about the whole concept of shareholder capitalism? Because this is a debate that hasn't happened so much in Europe, but has happened a lot more here in the States, because there is that much more of a deep attachment to a libertarian capitalist model of the economy. Now it's 50 years since Milton Friedman wrote his famous essay saying that the purpose of a company was to make profits for its shareholders, and by implication not to give money to charity or to worry about other stakeholders. And we've had the corporate roundtable, perhaps most famously led by Larry Fink of BlackRock, who we're also going to hear from at this conference, coming up with a different version of stakeholder rather than shareholder value last year, suggesting that there is more to capitalism than just maximizing profits. Do you think we do need to move beyond shareholder value? And if so, is there a risk that the concept of stakeholder value is a little too amorphous, that it lacks clarity?
Yeah, I think that we have moved beyond. And at the time last year in the Business Roundtable, it was actually under the leadership of Jamie Dimon at the time. And so when the Business Roundtable, which I'm on the board of, came out with the new definition of the purpose of a corporation, we debated it for many, many months and whether we should make the change or not. But one of the sentiments is that we're already operating like that. All of us know that it's not an or an or an or, it's an and. If I don't have programs that I'm supporting my employees and our people with ability to have the right sort of health programs and training and learning and growth, they're not going to be the best people with our customers. And if we don't treat our customers well, we don't have a sustainable business model. If you're not providing the right kind of service, we're in a very competitive world, and you need to put your customers in a level where you're providing a premium service with the ability to retain them and ensure they are getting what they need. The communities around us are also just as important as our supply chains, which we mentioned a little bit earlier. And when we had this dialogue within the BRT, it was around, even though the purpose of a corporation, the shareholder obviously is one of those organizations that you need to be thinking of and producing for and providing for. You can't do it if you don't have a sustainable business model and are not thinking about the rest of the stakeholders. And as we had that discussion, it was a very interesting discussion, because we were also looking to see, well, what is happening in the world around us? What's happening in the rest of the globe? And we saw that over and over, the stakeholder capitalism model was important. And we also wanted to make sure we could talk about capitalism itself, the importance of capitalism, and how capitalism creates so many jobs. And I'll go back right now to, we mentioned earlier the vaccine, and just think about the private sector, the way they're stepping up right now around the globe with this public-private partnership to develop a vaccine, and the amount of risk capital that's going into that. And so the private sector and capitalism should be healthy, it should be strong. And we want to ensure we can defend capitalism. But along with that, there's an approach to capitalism, which is providing ways that we can benefit all of the different stakeholders and not just be only about shareholders.
Okay, not rely on seeking shareholder value ultimately to benefit all stakeholders. It needs to be with a thought consciously towards all stakeholders, rather than shareholders as a means to everybody else.
Exactly. So if it's only about one, you potentially are missing. And I found it interesting, we were having a discussion, how many people started saying, well, my company already changed our policies 20 years ago or 15 years ago. And so now we're finally having a dialogue which is catching up to what we've been doing.
Now, another area that's become very interesting is that obviously one had the impression that people had moved on from the Milton Friedman model, but we do at this point in the US have the Department of Labor saying that 401k plans, over which it has jurisdiction, which is arguably the single most important pool of retirement money on the planet, that ESG is not a legitimate basis for pension funds, 401k plans to allocate money. Obviously, there have been some political events since that proposed rule came out, so it may be a dead issue. But do you think that is a real, that is a potential problem? Do you think that there may be some pushback against pension companies, pension funds applying ESG criteria?
I think there's two ways to look at that. One is that it goes in counter to the major moves around the world of the rest of pension organizations. As I mentioned before, GPIF in Japan has moved to go to sovereign wealth funds. GIC and Temasek have screens in what they do for ESG. If you go to Europe, as I mentioned earlier, you have a lot of ESG screens. So in one sense, it's going counter to what you're seeing around the rest of the world. And then in the private sector investments in the US. On the other hand, there is a legitimate concern for what could be called greenwashing, or funds that define, they say, oh, I'm an ESG fund, but then they don't follow their prospectus. So there really needs to be a lot of scrutiny. And I always warn people, if you're going to invest in something that says it's an ESG fund or an ESG mutual fund or ETF, or read it carefully, see what they say, because ESG is still not defined. As we've been talking throughout this conversation, standards aren't there. The way what you report is not standardized. The disclosure isn't standardized. There's still a way to go before this becomes a field that has consistency. Now, one of the ways I talk about it is it's like a snowball at the top of the hill, and it's a little snowball. And as it starts rolling down the hill, it's going to get bigger, it's going to accelerate. But as it gets bigger and accelerate, people are going to pay more attention to it and want to see more consistencies. So in a sense, what the Department of Labor is looking at, I would actually, in one sense, say, well, it's not such a bad idea that they're raising the flag of pay attention to what you're investing in. Make sure you're reading a prospectus, and make sure that what you think you're investing in is actually what you are investing in.
Right. Know what you know and know what you don't know. So yeah, it's always good advice somehow. Do you, one final question I'd like to ask, which is obviously one of the great problems of our age. It's why so many people are prepared to vote for populist alternatives around the globe, is inequality, the fact that there aren't as many well-paying jobs with full packages of benefits anymore. And one issue that does begin to arise is that a lot of companies that look good on ESG screens, specifically looking at their contribution to society, environment, and so on, tend not to be very labor intensive. That it tends to, ESG could be a means of sending a lot of capital in the direction of the kind of companies we perhaps don't want to encourage if we want to move away from, you know, this rather uncertain new world of the gig economy and of inequality. Do you think there's anything to that critique? Again, it's one that I've heard quite often this year and not really before. And if so, is there anything that you and other companies in your shoes might be able to do about it?
Well, first of all, there are areas, if you look at what is the highest demand within companies today, that are corporations, and everybody's looking for data scientists, they're looking for computer programmers. And we need to make sure that the knowledge economy continues to train people, and that the education systems are set up so that everybody gets a shot to learn about STEM education. And this is a broader policy issue that we should all be thinking about and helping to support. A second way to think about it is with the ESG. If you look at the energy transition that's going to be taking place, that will continue to require a lot of jobs that are not just the data type jobs. And along with that is a huge opportunity around the globe and in the United States for infrastructure. We have an aging infrastructure in the United States. The American Society of Civil Engineers rates the US infrastructure as a D+. And if you see what the airports need to do, the ports, the road system, we need broadband. There are a lot of very high paying, high quality jobs that are not just in the traditional of technology and financial institutions roles that are available when you think about an infrastructure program in a country like the United States. So I do think that infrastructure and green can go together quite well. It's a great way to create jobs. In the United States, every dollar of infrastructure investment generates about another $2.75 of additional economic activity. So I think there's a lot more beyond just thinking about the technology sector, and other ways to broaden through the energy transition infrastructure that will also create a lot of great jobs along the way.
Does that, I've asked you more about indexes and the equity part of S&P, but in many ways that goes to the issue of green bonds, social bonds, which have also really expanded in terms of issuance this year. I mean, is that another critical means of of advancing this agenda. It obviously is very difficult to get governments, and reasonably so, it's difficult to get governments to agree to spend taxpayers' money on this. Is this a way, do you think green bonds could become a critical way of improving the West's creaking infrastructure and doing so in an environmentally friendly way?
Absolutely. As you mentioned, it was equities, and it's mostly equities have had the most interest from ESG investors, but just along right behind them or right beside them is coming the fixed income investors. They're demanding much more information about the bonds themselves, about the governance, et cetera, the greenness or the brownness or whatever of that investment, what's it going into. So we see that there's a big increase in green bonds and environmental bonds, social bonds, et cetera. It's one of the most important trends in the fixed income markets. And then along with that, it's also interesting to see that what had originally been a high demand from equity investors for ESG data and analytics, now that's just moving just as fast over now into the fixed income investors. They're starting to evaluate the same factors, and they're getting the same questions from their investors, from the baby boomers and from the baby boomers' children, et cetera. So you're seeing the same demands come into the fixed income markets.
So I guess this is my final question. People often talk about demographics being destiny, and in fact, demographics can take you by surprise quite often. But this is a case where you would, I think, see this as a case where generational change, the steady demographic shift in the population, will more or less guarantee continued interest, a growing share of assets managed in an ESG fashion. ESG itself might change in some important ways. The criteria might adapt, but as I see it, as I interpret what you've been saying, this is something that's just with the turn of the generations is going to happen.
I think it is, and in addition to that, there's also such a consciousness of what you need to do to clean up the skies, and we've seen it actually. One of the interesting impacts is to see the before and after photographs of cities before COVID and after COVID, and even though everybody's home, it was a very unusual way to work. You saw the very clean skies, you saw lower carbon output, and that's another level of consciousness that we've seen. But one of the biggest dialogues is about the difference between the developed markets and the emerging markets, and how do you ensure that you can continue to have developing markets have access to capital, to infrastructure, to roads, but using clean energy, ensuring that they build their energy grids and their energy system on renewables or much cleaner than using coal as the way to start off on their energy journey. And you also have a demographic dividend in many of the emerging markets as they see their economies moving from a lower level of labor to knowledge economies, and as they build up wealth and savings, et cetera. So we need to also look at the developing markets to see how you can ensure that they leapfrog some of the development that the developed world went through to have a cleaner approach as well. But there's definitely a lot of interest in these. The interest is rising. It's at the corporate level, at the fixed in, the equities, but it's also developmental dialogue going on at groups like the World Bank and the IMF.
Okay, well, I think with that, thank you very much indeed. I think you've given us a great tour of the ESG landscape as it currently stands, and I hope we've provided a great start for the day at the conference. Thank you very much, Doug. Thank you very much, everybody, for listening, and enjoy the rest of the conference.